Hartmut Issel, Head Equity and Credit Group with APM CIO with UBS Wealth now joins us. Hartmut, good morning. Thank you for joining us. There are a lot of moving parts. 3 months ago, it was all about long live China. Then it became long live Donald Trump. Now it is come back to India. Forget the first two.
Morning. I would say, especially when the India market is concerned, right, it's positioned for India now. Okay, so how we looked at the markets a couple of months ago, we thought a bit difficult to justify the levels, but not only that, but we thought the market has to respond to what we think is the earnings trough in growth in fiscal 25, right? So March next year. Nonetheless, we're moving closer. Then, of course, right, it's only a couple of months left, really, right? And what we have modeled is actually an earnings inflection, a quite significant one indeed, right? So you almost double the earnings growth of the Nifty again in our forecast in fiscal 26. So whether it's the June quarter, right, but somewhere around the middle of next year, we think that earnings inflection will become more visible, right? That earnings trough is over. And with the correction, I would say here, India is certainly something we ask also our global investors and, of course, also our Indian investors to position for early.
Yeah. Okay. So what is the trade from here? Is it long India again? Is it still stay long dollar? What is the trade in the interim for next 6 months then?
Yeah. Dollar, we think, is probably about to peak or has peaked most likely already. So anything we celebrate the upside, and every time the dollar strengthens, we recommend to diversify more into some of the other G10 currencies. So if anything, there's probably the trade more there. Otherwise, U.S. remains, next to India, certainly in a stock market we like. And also the bond side is also quite interesting, right? Given our view that interest rates are about peak, they're probably going to come down maybe in the second, third quarter next year. Also the bond side, especially also investment grade, I would say is also quite interesting. So we have a couple of things to choose from.
Okay, point taken. But as far as India is concerned, one of the biggest challenges were valuations. Do you think that has come off, or given the kind of growth prospects that we offer, do you think people are okay to pay a bit more or pay that price for India?
It's the latter, very much the latter, I think. Right? Yeah, we all know India tends to stand out as being somewhat expensive, right? But so does the US, right? And these are sort of earnings compounding markets. So there's a reason why these markets trade at these type of premiums. And yes, as you rightly mentioned, they have come down. So the correction, we think, represents an opportunity. One thought I also would like to throw in here, right? So on my numbers, what we have modeled out, what I just mentioned, so almost a doubling of the earnings growth pace then in fiscal 26. You don't have many markets, even globally, right, where you see actually an earnings acceleration next year. Most of them, we think, especially the bigger ones, right, they come down a little bit in terms of earnings growth. So it really makes India also stand out. And that's also one of the reasons why we say in this combination, right, yeah, valuation is not completely cheap, right, but they have come down at least. And that prospect of being pretty unique in the world in terms of earnings, re-acceleration next year makes for a good combination.
Yeah, it's a good combination to have. So valuations do have come out, come down quite a bit. But if I had to ask you, Hartmut, as far as US market itself is concerned, I mean, last couple of months, especially after Trump re-election, it's ran up quite considerably. And the Trump trade was underway even before that with the dollar and the yields and all of that stuff. Do you think the US market is getting a bit toppish, or there's still value on the table there as well?
We think there's value on the table. And so we have a price target that equates to roughly 10% upside towards the end of the year. And, the Trump trade in some sense, I mean, there is reason to it, right? So you're seeing deregulation most likely, especially among the smaller banks, right? More appetite in the US, the smaller banks, maybe some consolidation in that space. So that's good for the financials. IT in any case, and that's probably independent of Trump, right? We have another probably 20% or so capex growth of the hyperscalers in the US that then also flows into the earnings side. So that is interesting. Utilities, right? If we look maybe in the US for something that has actually also the Trump trade maybe come a bit down, which is the utility sector, we also like that. It is kind of an AI proxy because the power demand or the acceleration in power demand is for real. So, no matter who is in the White House, and that is also an interesting place. Yeah, so we continue to like the US.
The anchoring for financial markets is always around interest rates. Before Trump got re-elected, the anchoring around interest rates was that Fed will keep on cutting rates, and it could be a fat rate cut of about 100 bips to 150 bips. Will that anchoring change going forward?
We think we haven't really changed our Fed path a lot, so we expect still a number of cuts, and also they can afford to. Right? So even you can argue about the fiscal deficit, budget deficit, and all these things, right? But it gives you a reasonable level of growth. Although we think that level of growth is moderating, right? Well, just as importantly, inflation, as we see, also is on the moderating trend. So the Fed has that leeway. And they're still actually quite restrictive if you look at it, especially also in real rate terms. So no reason really for the Fed to completely alter the path, and that also should continue to be, I should say, supportive for U.S. stocks in particular.
Hartmut, so let's understand what we should expect from equities and what we should expect from developed market equities, emerging market equities, and bonds in next 12-18 months. Which is their preferred asset class?
Right now, it is a bit hard. Right? We do like bonds and we do like equities, and really in a portfolio also, you still have ongoing uncertainties, and you will probably get tariffs and all these issues. So I would really say, right, let's not only choose one, but I think we can certainly here have these two, and as a hedge bit to the downside, especially also I would say for our Indian viewers here, gold we also think is quite attractive right now. Has also consolidated a bit, right? So there is more upside here, about 10 percentage points or so, also in gold. So let's bring different asset classes together.
Wow, gold has done rather well this year. Expecting further 10% up move on that one. That has been clearly the outlier of sorts. But if I had to ask you about the risks on the horizon, what are those major monitorables that you're watching out for right now that might derail the story a bit, whether in India or whether in US as well?
I would say probably in both cases, India and the US, one of the things that we're watching is certainly inflation, right? Because as we just discussed, there is at least the potential. It's not our base case necessarily, right? But we have seen also the recent inflation numbers in India is a bit above the expectations. So when anything gets derailed there, then yes, it certainly restrains the ability of the central banks to cut rates on both sides, right, US and RBI, the way we expect. So, next to tariffs, of course, everybody's watching tariffs these days, right? But arguably for India, hopefully a bit less, relevant, and for the US, not so relevant anyway. So yeah, I would, if you ask me about these two, I would highlight inflation as the area to watch.
Taken. So inflation is one big monitorable, but then what really makes you positive in India? And I ask you that because there are a few things working for us. Demographics is something which is positive. Regulatory framework has been quite positive as well. Give me the outside in view in the sense, what are those 2 or 3 points that make India look attractive at the moment, and what's the consumption story here in India looking like?
Yeah. Okay. I think everybody agrees. We all agree on the structural story in India, right? But there's always a tactical element to it. So the reason why up until 2 months ago we were actually neutral on India was not only valuation, it was the recognition, right, that in fiscal 24, let's say Nifty level, right, we had an absolute Goldilocks, right, far in excess of 20% growth, and to some extent that was also a combination of companies raising prices in expectations of input prices rising, and input prices in many cases actually fell. So we had a one-off, right? This type of earnings growth, even in India, is not sustainable, or not on that magnitude anyway, right? And sure enough, what we forecast was it doesn't repeat in fiscal 25, and it doesn't, right? We're seeing now since a couple of quarters that it was not sustainable. But here is actually the tactical upside, right, beyond the structural factors. So you have a number of sectors that are growing actually close to zero, which is quite unusual for India, right? And consumer is one of them. I would say, some of the big oil and gas is another one of them. You have other sectors I would mention financials that certainly grow below the potential, where we think, over 4 or 5 quarters, basically we're in the middle of it right now. This washes into the base, so middle of next year, right? You will likely see an uptick. You will likely see a reacceleration in, if I go at Nifty, it's about 80% of Nifty's earnings weight. These sectors are affected. These sectors are accelerating. So beyond the structural story, which is certainly there, and consumer cannot, as long as India grows above 6%, consumer cannot grow 0% for 2-3 years in a row. It won't, right? So yes, there are interesting opportunities also from a tactical point of view. Maybe 7-8 months out, but it's time to position for that ahead of time.
So consumption looks good and financials look good, but what's your recommendation to the client as to how to invest in India? And I ask you that whether you're looking at just investing into Nifty or the large cap stocks, or are you recommending them to go down the ladder a bit as well and maybe look at some of those select mid cap and small cap names as well? Are you going for a basket approach? Are you going for selective names? Are you going for direct, passive? Give me a bit more detail here.
Yeah. Would probably steer more towards the large cap side, right? Valuation growth, risk reward, if you will, looks better on this level. And then within sectors, as I mentioned, I think consumers at zero growth, for me that's a very clear opportunity here. Financials also, especially banks, right, have been a bit of a laggard for the longest time. It's also right. I think the softest point for them is also over. By the way, where we would maybe stay away from a little bit is the two-wheeler space. Two-wheelers, or many of the companies, maybe not all, but many of them, they have just peaked in terms of revenue or also earnings momentum. That is probably going to be a multi-quarter trajectory, a bit on the downside, maybe also with earnings downgrades. The valuations don't reflect that yet. So if you need some funding for some of the other sectors that I mentioned, that might be a place to look at.
Trim some position perhaps from the two-wheelers and deploy it in financials and consumptions. That's the crux of the matter. Thanks so much, Hartmut. It was great speaking with you, and hope you come more often as far as ET Now is concerned.
If you like this video, then like, share and subscribe to ET Now.